Good morning, good evening, good night, to wherever you may be watching this transmission. It is I, Mike Martins. I hope everyone's having a great hump day Wednesday morning here on the Western Seaboard. It is still 9:32 in the morning, and I want to throw out a quick article here from a few days ago from Wolf Street. Should be Wolf of Wall Street, but that's okay. Wolf Street. The story is behind business and finance and money. Don't forget to check out their website if you guys get a chance. So what are we talking about here? The holy cow momentum for subprime auto loans. Serious delinquencies blowout. Try saying that 3 times fast. What is happening? Well, R9s. R9 is the big, the two letter and number combinations you don't know you don't want to find on a credit score, especially when you are applying for a loan. R9 means you're 90 days past due. You're defaulting. You are not making it. You have a trouble to make a $40 payment on a credit card, or you've already been delinquent on auto loans. So I've spoken to a lot of people personally in the United States and Canada who are taking in their cars they bought 3 years ago for $70,000 that are probably realistically worth $22,000 with the junk they're made out of nowadays. So they could get something cheaper, something they could afford more, and a lot of dealers are scrambling, trying to make ends meet. And to me, for the dealerships, it's kind of a good thing because I got ripped off at dealerships maybe 3-4 times. So it's kind of a good thing to see, in my opinion, that dealerships are now having to. But the problem with seeing that is our tax dollars might bail them out or something. That's another scary thing. So everything's becoming federalized in a way where everything is being bailed out or propped up with tax money. And what does that make it? That makes it federalized, right? But it's even worse than it looks. At this time, there is no job crisis this time. It's the result of greed by subprime lenders. So what are subprime lenders? Well, if you don't go to your home or you don't go to your local home bank or your local bank that you go with or deal with because they won't touch you, it's for a very specific important reason. It's because they know you don't qualify. You either fall into a gray zone or you're put into a gray zone area where you have to take financing through the dealership, or you have to take financing through like a Hudson's Bay credit card, or like one of those 30% interest credit cards. And then that becomes that is a red flag right there. You should automatically think, if the bank can't touch me, then it's best for me to go ahead and follow through what they're telling me, or pay down some other debts or something. Usually they tell you, hey, you got to at least pay off your a cell phone delinquency that you have there that's been in with plaintiff and dockets there in your credit bureau. Pay that $2,200 cell phone bill from like 7 years ago off. Then we might consider doing something for you. But yeah, that's like a red flag right away, right off the bat. So here we go. Serious auto loan delinquencies. Auto loans that are 90 days or more past due in the third quarter of 2019, after an amazing trajectory, reached a historic high of $62 billion. According to data from the New York Fed today, holy smokes. This $62 billion of seriously delinquent loan balances are what auto lenders, particularly those that specialize in subprime auto loans, such as Standard Consumer USA, Credit Acceptance Corporation, and many smaller specialized lenders. You see, when you see that those advertisings, we approve you with no income. Yeah. Well, these woo. And now trying to deal with if they cannot cure the delinquency, they're hiring specialized companies that repossess the vehicles to be sold at auction. The difference between the loan balance and the proceeds from the auction, plus the costs involved, are what the lender loses on the deal. The repo business, however, is booming. But delinquencies are aflow. As current delinquencies are hitting the lenders' balance sheets and income statements, the flow continues and more loans are becoming delinquent. And lenders are still making new loans to risky customers, and a portion to those loans will become delinquent too. A lot of times they know already the person's going to go delinquent when they're doing this loan. Do you know why they go ahead and process it regardless if they know I'm just trying to think of a song to put into this phrase here. I love my commission. I love my commission. I love my commission. I don't care if this guy can't afford it. I want to buy Christmas presents. Na 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 na. I want my commission, and screw you if you can't pay it. And that's basically what it's all about in the end. The almighty dollar. And I've been saying this for a long time, guys. The Antichrist is money. And now the flow of delinquency loans is increasing. That isn't going to stop anytime soon. These loans are out there and new ones are being added to them. And a portion of them will be defaulting. I want my commission. I want to buy Christmas presents. I want my commission. I want to impress this girl that just is with me so I could take care of her. La 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 la. Total outstanding balances of auto loans and leases in Q3, according to the New York Fed's measure, higher and more inclusive than the Federal Reserve Board of Governors consumer credit data, rose 1.32 trillion. So here it is. Holy smokes. Auto loan balances in trillions? That could pay off some countries' complete debt, or some countries in... Serious delinquencies jumped 4.71% of these 1.32 trillion in total loans and leases outstanding, the highest since Q4 2011, when the auto industry was emerging from collapse and on the way up. This 4.7% is just above the level of Q3 of 2009. Remember 2007, 2008, and then the flow in 2009. Months after GM and Chrysler had failed for bankruptcy and a year later Lehman had filed for bankruptcy, the U.S. was confronting the worst unemployment crisis since the Great Depression, and when people were defaulting on auto loans because they'd lost their jobs. What happens? The taxpayers need to come in and save the day. Of course, the current rate of 4.71% is just 56 basis points below the peak of Q4 of 2010. But these are the good times and not an employment crisis when millions of people who lost their jobs can't make their loan payments. So we're not in an employment crisis right now. We're doing good. America's doing good, man. So what is going to happen to the auto loan delinquencies when employment experiences a pullback, even a fairly modest one, such as when 1 million people lose their jobs? That was a rhetorical question. We know what will happen. The serious delinquency rate will set a record for the annuals of history. But it's even worse than it looks. I want to make my commission, buy a car. Na, 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 look at my fancy suit. Na, 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 na. Girls, give me their phone numbers. Na, na, na. Most of them are wrong, but that's okay. I have a suit. Prime auto loans have minuscule default rates. The total of $1.3 billion in auto loans and leases outstanding includes leases to consumers who could pay cash for vehicles but lease them for various reasons. According to a different measure by Fitch, prime auto loan currency, the 60-day delinquency rate hovering historically low 0.28%. So this is for people that lease or pay or buy for specific reasons and stuff. And auto loans, minuscule, and auto loans and leases outstanding include leases to consumers who could pay cash for the vehicles but lease them for various reasons. So they're just doing that for basically an offset on their capital gains. That's all. Of the 1.32 trillion in auto loans outstanding, about 22% are subprime, so about 300 billion of them, roughly 62 billion, are seriously delinquent, or around 20% of all subprime loans outstanding, 1 in 5. But this subprime delinquency fiasco is not a sign of an employment crisis and brutal recession, as these types of numbers indicate during the financial crisis. Employment's still growing, and unemployment claims are near historic lows. Nevertheless, subprime auto loans are defaulting at outstanding rates. So it's like, what's going on here? Are people? I think people are just severely over leveraged. Guys, take it as a sign of goodwill when you go to the bank and they say, "Sorry, sir, we can't qualify you for this auto loan. Oh, it's okay. I got connections, and don't worry about it. I'll pay for it in cash. Instead of doing that, why don't you go home and reanalyze your financial situation, right? Create a TDS calculator. There's TDS calculators online. Find out why. Take your credit score home when they pull your credit score. Say, can I have a copy of my own credit score? Take it home. Look it through. Find out why you have gaps on file. Find out why you have so many inquiries. Understand what you're doing when it comes to this stuff. This is only you that should look out for yourself, because I want my commission. I want to buy a suit. I want my commission. I don't care if you can't pay. And that's what it's all about in the end. Subprime lending is risky but immensely profitable. The thing is, customers who have a subprime credit rating are painfully aware of it. They have been turned down for low interest rate loans. They have been turned away, and now they walk to a car lot where the credit rating suddenly is no problem and become sitting ducks. The industry knows this. They don't even negotiate. They just accept the price and the payment and the interest rate and the trade-in value. They're ecstatic to get a car, and they end up with a huge payment at high interest rates. And given how strung out they already are to be subprime rated in the first place, that loan is doomed. But I'm scared. Like, even if I owned my own auto used car lot or something, if I wouldn't go through like finance companies to do subprime financing for people that don't qualify. Like, I know City Finance does. I know Wells Fargo does. There's a couple of companies that do subprime for small companies to get people to apply for credit. And I don't think it's a good. I think I honestly would be more looking out for the customer and being really wary. Look, let's put a bigger down payment. Heck, you know what? I'll even drop another 10% on the car. It looks like you're, just to get you to afford food. I know you need a car to work, but you need to afford food too, right? That's the irony. A low interest rate loan on an affordable car sold at an average profit will give a customer much higher chance of keeping the loan current than the loan at 15% interest rate and the car customer can afford, including a big fat dealer profit and the type that can only be obtained from a sitting duck. These loans born out of greed and are doomed. That's it. It's, I want my commission. I want my commission now. I want to go to the nightclub and buy everyone drinks. I want to look special in front of everyone. This is what we are seeing here. These loans were born out of greed over the past few years as the industry was getting very aggressive in pursuing subprime rated customers because they're sitting ducks and so immensely profitable. What we're seeing are now the consequence of that greed. So enjoy reading Wolf Street and want to support it. So I don't think I'm blocking this. Let me just double check. I want to make sure I am not blocking these guys here. No. Here we go. There we go. I want to make sure I support these guys. There we go. There's the TELUS ads and all that other garbage. There we go, guys. Anyways, guys, let me know what you guys think in the comments below. Guys, let me give you a little bit of sound of advice. We're not on this earth for a long time. Okay? There's a lot of people checking out young nowadays. Checking out when I'm saying kicking the bucket at young. Just with stress and all this crap that's happening and people being overwhelmed with trying to be part of a status quo that's so fake, so delusionalized. I recommend buying a car, saving your money, buying a car for $800, $2,000, and in 3 years, I promise you, if you keep that car in good condition, you could sell it back for $2,000. You could probably sell it back for even more if you keep it in good shape. I know a guy that bought an 88 Toyota Camry for $2,000 and sold it back for $3,000 like 7 years later. I'm telling you guys as a friend, like I really don't want to see people doing this. You are a sitting duck. Please, I'm begging you to really look over your finances, really look over yourself. I know having a car is great and driving the family around and going to things and going to work, especially for work. You don't need it. Buy an old Camry, buy an old Cavalier. Just buy something go with a friend, a mechanical inclined friend, to look it over and make sure that you have a car for 2-3 years. There's a good chance you could sell it back for what you bought it for. Guys, please, do your research, please. Anyways, let me know what you guys think in the comments below. And thank you so much for watching. USA, F yeah.